Ladies and gentlemen, good day and welcome to Alicon Castalloy Ltd earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mayank Vaswani. Thank you, and over to you.
Thank you, Yashasvi. Good morning, everyone, and thank you for joining us on Alicon Castalloy Ltd Q1 FY25 earnings conference call. We have with us on the call today Mr. Vimal Gupta, Group CFO, Mr. Shyam Agarwal, Chief Marketing Officer, and Mr. Rajiv Gupta, Head of Domestic Business at Alicon Castalloy Ltd. Mr. Vimal Gupta will cover key developments and the financial performance for the quarter, following which Mr. Agarwal will walk us through the operating highlights. Mr. Rajiv Gupta will provide insights on the domestic business. Thereafter, we shall open the call for the Q&A session. Before we begin, I would like to point out that some of the statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings documents that have been shared with all of you earlier. I would now like to hand over the call to Mr. Vimal Gupta for his opening remarks. Over to you, sir.
Good morning and welcome to our earnings calls. Thank you for taking the time to join us on a Saturday. I trust you have had the opportunity to review our earnings documents which were shared earlier. We are delighted to share that Alicon has achieved its highest ever quarterly revenue in Q1 of 440 crores. This marks the third consecutive quarter where we have surpassed 400 crore milestone. This is driven by momentum in all our key segments of two-wheeler, passenger vehicle and commercial vehicle. Both domestic business and international business have done well. Further, this has been helped by efforts to build capabilities for new technology platforms in the automotive industry, expand into new geographies and focus on value engineering and capability enhancement, all supported by positive trends in our established business lines. The business is witnessing strong momentum and has outperformed the growth of the global and domestic automotive industry. We are in negotiations with more high-profile customers, including several leading global OEMs and many Tier 1 suppliers representing the best in the world in the auto industry. These customers are noticing the solutions that we offer, which include supply of world-class products at highly competitive prices. We have differentiated ourselves through expertise in low-pressure die casting and gravity die casting, and these processes are now gaining greater acceptance from customers. We are also in the initial stage of moving from as cast product to provide full machine products. As we start to increase the proportion of fully machined products, there will be further improvement in value addition. As we have shared earlier, this transformation can be monitored across three key metrics. We continue to increase the share of passenger vehicle PV and commercial vehicles in our product portfolio. This segment now represented 57% of our sales in Q1 of 25, up from 50% in Q1 of 24. Our customer profile is evolving with the addition of prestigious global names, including leading OEMs and Tier 1 companies. This reflects Alicon's growth stature in the industry, and we continue to add to our client roster in each quarter. The focus on design, R&D and value engineering has ensured that Alicon is now increasing recognized not just as a source of build to print components, but as a solution provider known for innovation, technology and design. If we compare Alicon of 2018 with Alicon 2024, you will notice the following progress. In 2018, there was an over-dependence on two-wheeler customers, while today we have a more balanced mix of two-wheeler, passenger vehicle and commercial vehicle segment in our portfolio. In 2018, our Customer list comprised largely domestic customers, while today we have some of the largest, most prominent names in the world, including Indian OEMs who have scaled themselves too. In 2018, we were reliant on cylinder heads, while today we offer a diverse mix of critical products. As a result, the margin profile in 2018 was in high single digit of 8 to 9%, while today we have a margin profile of around 13% and are working on further improvement for that. Now let's turn to our financial performance Q1 of FY25. We reported revenue of 440 crores, representing a 24% increase from 350 crore in Q1 of FY24. Revenue growth has been driven by the scaling up of production for new product parts, many of which are critical components being supplied for passenger vehicle and commercial vehicle customers. Our gross margin for Q1 of FY25 is 50.42% as an increase of approximately 25 basis points compared to 50.17% in Q1 of 24. This is due to the improved product mix on a year-on-year basis. Employee costs have risen by 19% year-on-year, driven by increments, rise in minimum wage and cost of new hire aligned with our operational growth. While the impact of ESOP cost has reduced, as anticipated, there were some temporary additions in the European operations which have driven up employee costs. In terms of profitability, the EBITDA for Q1 FY25 was 58 crore, a 46% increase from 40 crore in Q1 of FY24. The EBITDA margin improved to 13.2% from 11.3% in the previous year, despite the rise in employee costs and other expenses, reflecting a year-on-year improvement of 194 basis points. On a quarter-on-quarter basis, the EBITDA of 59 crore in Q4 of FY24 has been largely maintained, while the EBITDA margin has moderated from 14% in Q4 to 13.2% this quarter. Absolute EBITDA of 58 crore in Q1 represents a strong start to the fiscal year. Further, it would be important to note that wage hikes have been implemented this quarter and certain expenses have been provided for estimated this quarter, on which we will get greater clarity as we progress through the year. Going by the trend in earlier years, the Q1 margin tends to represent a base and we expect to see some improvement through the rest of the year. Finance cost has increased by 9% year-on-year to 10 crores, in line with the increased borrowings. Finance costs are, however, lower by 5% on quarter-on-quarter basis when compared to Q4. Depreciation rose by 22% year-on-year to 22.44 crores, driven by new asset additions comprising machines and tools added or replaced in our production lines. After absorbing the higher finance cost and depreciation, PBT has more than doubled on a year-on-year basis, as it was higher by 109% from 12 crore in Q1 of FY24 to 25 crore in Q1 of FY25. The PAT for Q1 FY25 stood at 19 crore, higher by 2 times from 9 crore in Q1 of FY24. Regarding capital expenditure, we have spent approximately 49 crores in Q1, primarily on machinery for production and investments in new product development. For the full year, we have a target of roughly 150 crores for FY25, reflecting the heightened level of activity. In terms of our growth outlook, we continue to anticipate revenue of 1,800 crores this fiscal, representing around 15% growth for the fiscal year. While our strong Q1 revenue performance of 440 crores represents nearly 25% of the annual target. We are carefully watching the global macroeconomic backdrop and the volatility that could emerge from the intensifying conflict in the Middle East, and will update on this targeting Q2. We are highly excited and energized by our business prospects and the discussions that are going with the several potential customers. While sentiment towards electric four-wheeler vehicle is currently muted, we have strongly positioned ourselves on hybrid technology, and two key customers in this domestic market, Toyota and Maruti, are indicating exciting potential for their hybrid vehicles. Further, volume of two-wheelers have picked up well given the improving rural backdrop. With that, I will now hand over to Mr. Shyam Agarwal to share the operating highlights for the quarter.
Thank you, Mr. Bimal. Greetings to all. We are delighted to report our highest ever quarterly revenue in Q1, as well as reporting revenue of over 400 crore for the third successive quarter. In addition to revenue growth of 46% on YOY basis, we have reported growth of over 100% in PBT and PAT respectively. With this performance, we have started FY 24-25 on a strong note. Coming to some of the key business programs this quarter, we have witnessed further ramp up from Maruti this quarter. We had indicated that the supply of cylinder head to a second model combined with start of supply to the Gujarat plant of Suzuki would lead to increased volume. We are pleased to share that with this ramp up, the volumes being supplied to Maruti have tripled on a YOY basis. For Toyota, where we supply cylinder head to their hybrid models, we have witnessed further rise in volume this quarter. We have augmented the production lines to meet the demand and are in discussion with them to assess further ramp up of requirements in the near future. Over the long term, we see further demand requirements given that Toyota will be adding to their manufacturing capacity. Our position as an approved supplier provides an opportunity to increase volume with his enhanced capacity. We had recently commenced supply of cylinder heads to Stellantis India. Volumes to their Hosur plant have been ramped up in Q1. I am sure some of you are aware that Stellantis is seeking to make the Hosur facility into an engine manufacturing hub, which will serve to the domestic market and from which engine will also be assembled and exported to Europe. Alicon has developed a model plant imbibing cutting-edge technology and automation for the Stellantis product. This plant serves as a reference point for other potential customers as well. As a single source supplier of cylinder head for the Stellantis, we are closely monitoring the requirements to ensure that we scale up our capacity in alignment. In our European operations, we continue to witness strong momentum. The production of e-axles for Jaguar and Land Rover continues on schedule. Production will continue into the third quarter, following which supplies will shift to the Indian plant in order to produce scaled up volume. Further, we see strong momentum in the battery housing product for hybrid vehicles that we are supplying to Samsung, a tier 1 supplier. This product is supplied to 3 different vehicle models, and there has been a steady ramp up in the volumes in Q1 with indicators for the further ramp up in financial year 2025-26. I would also like to touch upon 2 exciting projects that our European team is working on. The first one, we are currently developing a product for Volkswagen autonomous driving, positioning us at the cutting edge of the emerging technologies in the auto mobility sector. A well-defined schedule guides our product development, and we have already commenced manufacturing of the tool needed for the production. This initiative opens up a new market segments for us with the application of ADAS poised for widespread adoption across the automotive industry. Secondly, we are actively contributing to the E-Highway project, a groundbreaking initiative jointly developed by Siemens and the Continental. This project aims to electrify highways, allowing electric trucks to recharge while in motion. Our role in this venture includes the supply of 8 distinct components, which will be integrated into the top of the trucks to facilitate electrification. We have already delivered initial samples and further evaluations are currently in progress. As Europe enters the summer season, we have also begun manufacturing swing arms for our European two-wheeler clients. As many of you know, we are proudly supplied to each of the top 4 premium motorcycle manufacturers in Europe, that is KTM, BMW, Husqvarna and Ducati. Initial shipment started in Q1 and we are gearing up to significantly increase volume in Q2. Overall, our European operations remain stable with no significant risk on the horizon. Gas prices, power availability and overall costs are largely steady and we have not observed any upward pressure on commodity prices thus far. We expect the balance in our product mix to improve further as most of the new business that we have won this quarter is supplying for four-wheeler or for the global customer. This is aligned to our strategy of focusing on high-value parts. In terms of industry trends, we see that hybrid vehicles are currently outpacing electrical cars in market growth, driven by their appeal as a practical transition between traditional and fully electric vehicles. In 2023, hybrids saw higher sales growth than electrical vehicles in major markets like Europe and Japan, reflecting consumer preference for their flexibility and the existing fuel infrastructure. Many buyers favor hybrid over electrical vehicles due to concern about charging availability and range limitation. In response, automakers like Toyota have strategically increased hybrid production, recognizing a strong demand in this segment. As a result, hybrids are emerging as a key growth area within the automotive industry, offering a compelling investment opportunity. We are well positioned to capitalize on this both in terms of offering as well as association with some of the largest global and domestic customers spearheading this. Another interesting update to share with you is the addition of the cold core box manufacturing facility this quarter. Another interesting update to share with you is the addition of the cold core box manufacturing facility this quarter at our Shikrapur plant in Pune. This is a new technology for the critical parts. With the installation of this advanced equipment, we have enriched competencies further. This technology will open up several new opportunities, enabling us to further enhance customer wallet share. We are also taking decisive steps to enhance our manufacturing capabilities by integrating advanced digital process control across our operations. By leveraging machine intelligence, we are adding a sophisticated layer of oversight that boosts both precision and efficiency on the production floor. These controls are designed to provide us with real-time data, enabling us to actively manage our operations with greater accuracy. More importantly, this technology will equip us with the insight needed to make smarter, more informed decisions that ensure that we make our manufacturing processes more efficient and benchmark them with global best practices to reflect our evolving customers and the product profile. The other area in which we have made considerable progress is in diversifying of our energy mix. As we have shared earlier, we have installed the solar panels on the rooftops of our plants in both India and Europe. We have generated about 30% of our energy consumption in Europe from solar energy, which has made our operations more resilient and more competitive. Additionally, in India, we have invested in a solar installation and entered into a 5.2 megawatt solar power agreement, which will allow us to gain equivalent credits for the energy we contribute to the national grid. Part of this has gone live, with the remaining infrastructure set to go live in January 2025. The energy fed into the grid will offset the power we consume at our manufacturing facilities. With these steps, solar energy already contributes 40% of power and will soon account for over 50% of our total energy mix once the next phase is commissioned. With that, I will now hand over to Rajiv Gupta for his comments. Thank you.
Thank you, Mr. Shyam. Greetings to all of you. In Q1 FY25, auto sales showed a healthy performance, especially the two-wheeler segment, which continued to outperform. So in Q1, we noted 20% growth in 2W segment on year-on-year basis, 6% growth in passenger vehicle segment on a year-on-year basis, and a dip of 1% in commercial vehicle on a YOY basis. In the domestic market, we experienced a strong resurgence in the two-wheeler market, reflecting a significant rebound in demand. Last quarter, we had projected an increase in the two-wheeler volumes in anticipation of the upcoming elections, and this forecast have been realized with substantial growth. Additionally, we observed an encouraging improvement in the rural demand, which has further contributed to the robust year-on-year increase in volumes. This positive momentum suggests that the demand for two-wheelers is likely to remain strong throughout FY25, supporting our outlook for sustained growth in this segment. Overall, the market conditions appear favorable, and we remain optimistic about the continued performance of the two-wheeler business. In the passenger vehicle segment, utility vehicles continue to witness favorable momentum. Further, the sentiment around EVs is somewhat subdued, and customers who were unable to decide are now more firmly in favor of hybrids or internal combustion engines. Having built up offerings for hybrid vehicles, we are well positioned to take advantage of this trend. In Q1 FY25, the retail volumes of commercial vehicles saw a marginal decline. The global markets have been sluggish due to uncertain economic outlook and persistent inflation and the increase in conflicts and unrest in various parts of the world. With the heightened uncertainty, we anticipate that there will be apprehension and cautiousness from customers and are closely monitoring the situation. In Q1, we added 8 new parts from 5 customers. This includes 1 part from the carbon neutral segment, 1 part from the non-auto, and 6 parts from the ICE segment. Of these 8 parts, 4 parts remain to the domestic business and 4 parts remain to the international business. In an exciting development, a global automotive customer has awarded us an order for 2 critical parts. This will be produced in India for supply to USA. We estimate that the potential size of this order over its life can be over 500 crores. Interestingly, this will involve supply of machined and assembled part, enabling us to capture higher amount of the value addition. This will add to the USP which we can demonstrate to existing and prospective customers. We have also received orders for 1 part each from Daimler and Danfoss this quarter. These pertain to application in commercial vehicle and will entail exports from India plants. The part from Danfoss pertains to an carbon neutral segment, while the part from Daimler will find application for ICE towards a new generation engine with enhanced vehicle performance. In the domestic business, we have received 3 parts from Maruti Suzuki, which will increase our wallet share. This adds to our business from the passenger vehicle segment. All these parts pertain to the ICE business. In the non-auto business, we have added a product with BEML for a defense segment. The increasing spends towards infrastructure and defense should lead to further opportunities in this space. The global business contributed to 26% of the total revenue during the quarter, which is higher than 23% in Q1 last year. Further, 94% of our business is from auto and 6% is from the non-auto customers. During Q1 25, Alicon has booked new orders aggregating to 650 crores. The new business added is aligned to a strategy of higher value add, and it is largely passenger and commercial or global business. With this, our total new order booking have surpassed rupees 9,500 crores, which will be executable over a period of 6 years from 23-24 up to 28-29. On this note, we shall open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take our first question from the line of Yash Dalal from Sushil Financial Services. Please go ahead.
Yeah, hi. Firstly, congratulations to the management for again recording your highest ever quarterly revenues for the 3rd consecutive quarter. So I had a few questions. The first one was, what is the new business contribution for the quarter? You had mentioned last quarter that majority of the new business added pertained to 4-wheelers and was for international markets as well. So will this trend continue in FY25? And what is the order pipeline for this as well as for the overall business?
Yeah. So on the new business, yes, rightly said, you have noted a good performance last fiscal, where our order bookings were around 95% to the global market and 95% to the 4-wheeler market and 85% to the international markets. And this quarter also we noted a good momentum. So in this quarter, we booked a business of around 650 crore. Out of that, the major addition was from a global market for a 2-wheeler premium high-end segment. And this is also a good foray to add and demonstrate our existing and global customers about further value add what Alicon can add. So good momentum.
Yeah, and yes, I would like to add here. But focusing more on the 4-wheeler customers, considering the value addition which we are getting is higher than the 2-wheeler. But in this business, we have got the good value addition as compared to our 2-wheeler customers and even more than the 4-wheeler customers. So it's a good business acquisition for us.
Okay. Then the next question is, what has been your volume growth for the quarter? And you had mentioned that in your FY26 revenue target is at 2,200 crores with around 14-15% EBITDA margins. So beyond this, what does the future hold for Alicon beyond FY26?
So beyond 26, yes, that what we are talking about earlier also, that we are expecting a CAGR of approximately 15 to 16% in the top line.
Okay.